Welcome to a deep dive into value investing in the 21st century. Today, we're exploring how to find undervalued gems in today's fast-moving markets. This is deep value investing, a strategy that's been around for decades. It's about buying stocks that are priced far below their true worth. Think of it like finding a dollar bill someone's selling for 50 cents. Sounds simple, but it takes skill, patience, and discipline. In this video, we'll break it all down for you. We'll cover the basics, the strategies, and the tools you need. Plus, we'll look at real-world examples based on the latest market trends. By the end, you'll have a clear roadmap to start your own journey. Let's start with what deep value investing really is. It's a strategy rooted in the ideas of Benjamin Graham. Graham was a legendary investor and mentor to Warren Buffett. He believed in buying companies at a discount to their intrinsic value. Intrinsic value is what a company is actually worth. It's based on assets, earnings, and future potential, not just what the stock market says it's worth today. Deep value takes this a step further. It focuses on stocks that are extremely undervalued. Often, these are companies the market has ignored or misunderstood. Maybe they're in a struggling industry, or they've had a temporary setback. The key is spotting potential before others do. Why does this matter in the 21st century? Today's markets are more complex than ever. Technology has changed how we invest. Information moves faster, and prices adjust quickly. Some say deep value investing is harder now, because markets are more efficient, but opportunities still exist. You just need to know where to look. Let's talk about why deep value still works. First, markets aren't always rational. Investors can overreact to bad news. A single poor earnings report can tank a stock, even if the company's fundamentals are solid. Second, entire sectors can fall out of favor. Think about energy stocks during a tech boom. Good companies get ignored just because of trends. Third, small companies often fly under the radar. Analysts don't cover them as much as big names. That creates hidden opportunities. So, how do you find these undervalued gems? It starts with understanding key metrics. One of the most important is the price-to-earnings ratio, or PE ratio for short. It compares a company's stock price to its earnings per share. A low PE ratio can signal a stock is undervalued, but it's not foolproof. Some companies have low PE ratios for a reason, like declining profits or heavy debt. Another metric is the price-to-book ratio. This compares a company's market value to its book value. Book value is the value of assets minus liabilities. A price-to-book ratio below 1 often means a bargain. But again, context matters. You also want to look at free cash flow. This is the cash a company generates after expenses. Strong free cash flow shows a company is healthy. It can reinvest in growth or pay dividends. Dividend yield is another clue. A high yield can mean a stock is underpriced. But be careful. A very high yield might signal trouble. Like a dividend that's not sustainable, these metrics are just the start. You need to dig deeper into a company's story. What's its competitive advantage? Does it have a strong brand or unique technology? How's the management team? Are they making smart decisions? What about the industry? Is it growing or facing challenges? This is where research comes in. You'll want to read financial reports. Look at balance sheets and income statements. Check for red flags like high debt or declining revenue. You can find this info on company websites or platforms like Yahoo Finance or Morningstar. Another tip is to follow insider activity. When executives buy their own stock, it's a good sign. It shows they believe in the company's future. You can track this on sites like sec.gov. Now let's talk about where to look for opportunities. One place is out-of-favor industries. In 2025, some sectors are overlooked. Take traditional energy, for example. With the focus on renewables, oil and gas stocks are often ignored, yet many have strong cash flows and dividends. Another area is small-cap stocks. These are companies with market caps under $2 billion. They're less followed by analysts, which means more chances for mispricing. You can also look at companies with one-time setbacks. Maybe they lost a big contract or faced a lawsuit that's now resolved. These stocks can be undervalued but poised for recovery. Let's look at a few examples from 2025. These aren't recommendations, just illustrations. always do your own research. First, consider a company like General Motors. It's been around forever, but it's not a tech darling. In early 2025, it trades at a PE ratio below 6. That's low compared to the market average of 15. General Motors is investing heavily in electric vehicles. It's also got a stake in autonomous driving. Yet the market seems focused on newer EV companies. This could make it an undervalued gem. Another example is British American Tobacco. Tobacco stocks aren't popular these days. Health concerns have driven investors away. But this company has a dividend yield over 8%. It's also diversifying into vaping and nicotine pouches. Its global reach adds stability. Still, the stock trades at a discount. A third example is T. Rowe Price. It's an investment management firm. It manages over $1 trillion in assets, but recent market volatility hurt its revenue. The stock's PE ratio is below 10. As markets stabilize, it could rebound. These examples show how value investing works. You find companies with strong fundamentals, but the market hasn't caught up yet. Now, let's talk about the risks. Deep value investing isn't a get-rich-quick scheme. One risk is value traps. These are stocks that look cheap but aren't. Maybe the company's dying, not undervalued. Another risk is time. It can take years for the market to recognize value. You need patience and a long-term mindset. There's also market risk. Economic downturns can hit value stocks hard, even if they're fundamentally strong. To manage risks, diversify your portfolio. Don't put all your money in one stock. Spread it across industries and company sizes. Also, keep cash on hand. It lets you buy when prices drop. Finally, stay disciplined. Don't chase trends or panic sell. Stick to your research and strategy. Let's explore some modern tools for value investing. Technology has made this easier than ever. Stock screeners are a great place to start. These let you filter stocks by metrics, like low PE ratios or high dividend yields. Popular screeners include FinViz and TradingView. Many brokers also offer free screeners. Another tool is financial modeling software. This helps you estimate intrinsic value. You can build discounted cash flow models or use platforms like Guru Focus. Social media can also be useful. Platforms like Twitter and Reddit have investing communities. You can find ideas and debates there, but always verify what you read. Don't trust random posts blindly. What about artificial intelligence? AI is changing value investing. Some platforms use AI to analyze data. They can spot patterns humans might miss, but AI isn't a magic bullet. It's a tool, not a replacement for judgment. Let's talk about building a strategy. First, define your goals. Are you seeking income or capital gain? This shapes what stocks you pick. Next, set criteria for your investments, maybe a PE ratio below 10, or a dividend yield above 4%. Stick to these rules to stay focused. Third, decide how many stocks to hold. A portfolio of 10 to 20 is usually good. It balances diversification and focus. Finally, review your holdings regularly. Check if they still meet your criteria, but don't overreact to short-term noise. Let's wrap up with some key takeaways. Deep value investing is about finding bargains. It requires research, patience, and discipline. Use metrics like PE and price to book, but also understand the company's story. Look in overlooked places, like small caps or unpopular sectors. Leverage tools like screeners and AI, but trust your own analysis. And always manage risks. Diversify, stay patient, and keep learning. Deep value investing can be rewarding. It's not about following the crowd. It's about seeing what others miss. Thanks for watching. If you found this helpful, give it a thumbs up. Subscribe for more investing insight, and let me know your thoughts in the comments. Until next time, happy investing.